Good day and welcome once again to another session of lectures with AAA Professional Institute. This is an SFM class and we shall be looking at capital budgeting in this class. Capital budgeting is otherwise known as investment appraisal or project evaluation as the case may be. Very quickly we look at the definition, processes, the methods, and then we look at illustrations to guide us as it is appropriate. So we look at the definition of capital budgeting. We understand that every everyone is in business in order for them to make profit. But then, strategic financial management simply is talking about a financial manager being able to have the capital that is in the business, is available to the business for adequate and appropriate investment. Without an adequate and appropriate investment, it will be impossible for a business to actually make profit. So, by definition, capital budgeting is a process of appropriating the available capital in the best way in order for us to maximize what we call the shareholders' wealth, which is, of course, to make profit. Every shareholder or any owner of business, in order for them to make profit. And financial managers, they have to ensure that this is possible. And so we move quickly. What are the processes? If you are a financial manager, what are the processes involved for you to be able to appropriate? So the processes now that is involved in appropriating very quickly can be into, let's say, 4 or 5 places. The first one is you need to identify available opportunity. You identify available opportunity. That is available opportunities. Opportunities as it were. So what we're saying is you have your capital is available, the funds are available. The first thing first is, as a financial manager, you need to identify available opportunity. That is, in order for you to be able to appropriate that capital, it is important for you to know what is available. What can I put the fund that I have into? What can I put the capital that is available into? Those are the available opportunities. Number 2, you need to screen this available opportunity to align with the company objective, to align with company OBJ, company objective. That is, various opportunities are actually available, but every company have their goals. They have their strategic objectives. So you must screen every available opportunity into those objectives. For instance, you are into cement factory. You know that you have funds available. You want to expand it to other areas. You need to know where exactly to put those funds in order for you to maximize the shareholders' wealth, to align with the objective of the organization or the company as a financial manager. So after you have done your screening, the screening is to mirror down those opportunities into which ones exactly align with the objectives, and so that you can perform what we call the next step, which is evaluation. You evaluate each of these opportunities that you have screened or that you have mirrored down. You evaluate them into profitability, into what we call profitability. You need to evaluate them into profitability. What we're saying is this: if you have already screened those opportunities, and then you know these ones align with the business that we want to do, align with the organizational goal, you should be able to evaluate each of them to know which one is viable, which one is profitable, and which one is not profitable. So under this, that's where we have the methods that we will be looking at. Under this evaluation, we have various methods that we can use, and those methods can be divided into what we call the traditional method of evaluation, as well as the discounting method. Under the traditional method, we have 2 major methods, there is one that we call the payback period method, and then there is what we call the accounting rate of return. When we get to those methods, we look at all of these put together. Then we have the discounting method. Our discounting method, what we call the net present value method. Then you have what we call the internal rate of return method. You also have what we call the modified internal rate of return. Then you have what we call the adjusted present value method. All of these are methods to evaluate the profitability or the viability of the investment or the opportunity you want to invest in, or you want to invest in, or the project you want to put your funds into. And then the last process is the second or the last, as it were, is to measure. Okay, let me put that under here. You should know that we are still under process. Is to measure. Is to choose the project. Choose the project you want to invest in. Project or opportunity you want to invest in. It's important. You must choose. And then the last one, which is the process, is to do what we call post-audit review. Post-audit review. That is to say, you need to check if the project you have choose, that you have put your money into, if it's actually doing what you expected the project to do. You need to do the review to be sure that if you will need to call back the project, that's number one. If you need to call back the project, maybe you invested the money in a wrong project, or why did you invest such money in that project, or what can you remodify in the process? And those are the essence of why we do what we call post-audit review. You can be asked in your exams, post-audit review, explain and give us why we should do it. It's important that you know it, just like I've said. It's very simple. Post-audit review is for you to know whether what you have put your investment into is working, or if you need to call back the project, or if you need to remodify the investment and the likes like that. So that is that for the processes now. So let's go to the method very quickly. So we look at the methods like I said right now. Then we start with the payback period method. The payback period method. These methods look at the time period where an investment will be returned. That is, if you put your investment into a particular business today, you are looking at the time that the investment will return to you. It can be, if you put your money today, it can be in the next 2 years that the money will return to you. Take, for instance, if you put 1,000 naira into an investment, you need to know when exactly will the business return back to you. The formula to do that is your initial investment, initial investment, that is the money that you are putting in, all divided by annual cash flow. So what we are saying is this: for instance, now, if I put 1,000 naira in a business, and then I expected that this business should give me 500 naira every yearly, means that my payback period will be equals to 1,000 naira divided by 500 naira, and that will be equal to 2 years. It's as simple as that. Whatever question that they are giving to you, this is just the basic. This is all that you need to do in it. Yeah. And then the second one under the traditional method is the ARR method, accounting rate of return method. This accounting rate of return method is the same thing that is known as your return on investment method. And this one is looking at the formula rather is average accounting profit divided by annual investment. Average accounting profit divided by your average annual investment. It's as simple as that. Just like, for instance, if they say that you make a profit from a business yearly, you make, let's say, 50,000 naira yearly on a business, 50K yearly on a business, and then this business will be for, let's say, for 4 years, or let's say 50,000 from an investment. Rather, let's not put business here so that some of you will not get confused on investment. And this investment you are projecting to be for 5 years. And then they said the investment that is put in this business is, let's say, 500,000. If it's 500,000, they now said, what is the accounting rate of, get the viability of the project or the investment using the ARR method. All that you need to do is to look at, they said, average annual accounting profit. And what is your annual accounting profit? Is 50,000. What is the number of years? Is 5 years. So what you just need to do is you determine your average annual accounting profit. That will be equal to 50,000 and divided by 5 years. That will give us, that should be 10. That will be equal to 10,000 as it were. And they said your annual investment or the investment or the outlay that you put into is 500,000. What that you need to do in getting your average annual investment will be this 500,000 divided by 2. Normally, assuming we have residual value, we are going to remove it from this one, and so that we can divide it by 2. So you just divide it, and that will be equal to 250. 250. So your ARR now, ARR will be equal to 10 divided by 250. So when you divide it, you know what? So that will be equal to 0.044, which is 4%. So the return on that investment will be 4%. That is, if I put in my 500,000 into the investment, I will be expecting annually 4% return. So this traditional method, these are the two methods on the project evaluation or investment appraisal as it were. However, you see, they have their advantages, they have their disadvantages. And the advantage is that it is simple to use, it is simple to understand, and then it is simple for you to comprehend. That's the basic advantage. But the major disadvantage is that they do not take into account the time value of money. That is, all this cash flow that we are looking at and the likes, they are future projections. So you should be able to know what will be the present value of those future projections in today's time. So the disadvantage is that they do not take into account the time value of money. Another disadvantage, let me quickly mention that, is that under the payback period, the cash flow at which the investment return is the only one that is being used. Other cash flow afterward, they are neglected. And then all cash flow are important when you are doing your valuation. Whereas under the ARR, for instance, ARR do not even use cash flow at all. Rather, it uses accounting profit. And this accounting profit are what we call the non-cash items. And these non-cash items, they do not really represent what you can base your decision on. What do we mean by that? Like depreciation, provisions, all those non-cash items, and some of these are historical costs. They are all embedded for you to get what we call this accounting profit. That's what makes, if you base your decision on it, you may not be making the appropriate decision. That's another disadvantage to the use of this method. And that is why we now have what we call the new method, which is known as the discounting method. And because the discounting method in itself make the most of what we call looking at the time value of money. These ones, they do not make the most of time value of money, but rather they just use the cash flows as well as the accounting profit. So the next one will be the method, discounting method, which uses the time value of money. So under this discounting method, like I said, we have what we call the NPV, the net present value method. This present value method, what the formula is your net cash outflow, which is also your initial investment, all those outflows as it were, minus your net cash inflow. The net cash inflow, you multiply it by your variable, that is your discounting factor. Whatever you get will either be positive or negative NPV as it were. So that is just a summary of whatever table that we are doing under the NPV. You understand? So that is that for that. If we have an example, we will look into that before we move forward. However, let's go and run all through all the methods under the discounting method. Then we'll now take a look at illustrations in our next class. But let's build a background. What we're doing is to build a background. Okay. And then the next one under the discounting method is the internal rate of return method. Internal rate of return method. That one also has its own formula. You understand? And then the first is you must always determine what we call the positive NPV or the negative NPV as it were. That is, if you get your positive NPV, you must get your negative NPV for you to be able to do what we call the internal rate of return. The internal rate of return is simply talking about the rate at which a company cannot go below in order for them to break even. That's that for the internal rate of return. Also, your net present value when you evaluate it will give you what we call a value figure in currency, whereas your IRR will give you returns in percentage. That is the differences in this one. The IRR formula is what we call the lower rate. That is the lower rate now. The lower rate will always give you positive NPV. To always give you your positive NPV plus lower rate NPV divided by lower rate NPV plus higher rate NPV. Your higher rate NPV will always give you, most of the time, will always give you negative NPV, and then most of the time, often, that's what it will always give to you. Then multiply by higher rate minus lower rate. That is to say, when we're talking about this rate, we're talking about the discounting factor. Every discounting factor that you use to get your positive NPV is known as the rate that is being used for evaluation here. So what we are getting here will be in percentage. Then NPV, you will get what we call a value, a figure value. That's just the differences between the two. But each of these methods will tell us, how viable an investment or a project will be. Then the next one is the APV. The APV, or yes, let's look at this APV. Then we'll now come to the MIRR. The APV is looking at, for instance, under the net present value and IRR, the discounting rate that you are using is known as the weighted average cost of capital. And this weighted average cost of capital combine both the cost of equity and the cost of debt together. Whereas under the APV, we separated this cost into cost of equity and cost of debt in evaluating the cash flow as it was. So the APV, we look at the formula is, let's go with the formula first. We have what we call the base case NPV plus financing effect. So in getting your base case NPV, we have been valuing with weighted average cost of capital. We value with cost of equity. Then for your financing effect, we value with cost of debt. So what we are looking at is this. If you value the cash flow by the cost of equity, this one is the residual, the residual, that is the owners. The cost of equity is the cost, the risk and the return for the owners of the business. If you are valuing their cash flow based on this, it means that you have removed all the debt element from the cost of capital that is in the portfolio of the business. So what we are saying is this: you are going to be able to evaluate appropriately and know exactly how the financing effect has affected the cash flow, as it were, in evaluating the investment. So, and then the last one is the modified internal rate of return. The proponents of this method assume that the internal rate of return can actually be modified by looking at the present value of inflows as against the present value of outflows and multiplied by the discounting factor. So the formula is a present value of inflows divided by present value of outflows raised to power 1 over n or minus n, as it were, multiplied by 1 plus r. R is the discounting factor, all minus 1. So here, what we say the present value of an inflow is 50. Then we say the present value of an outflow is 100. Raised to power, let's say number of years that they are forecasting for the investment is 10. That will be minus 10 or 1 over 10, whichever. Then they said our rate. They say our rate is also 10%. We just say 1 plus 0.10, 0.10, all minus 1. All of these minus 1. That is all that is about modifying internal rate of return. So what we do is we have been able to build background and formulas on this. You can just view it all over again, and then we take each of them one after the other and do illustrations on them for adequate understanding. Thank you for watching. Please look forward to the next video.